A lot of the times we look mostly to either our home country, the US, China, Japan, the big markets when it comes to stocks. But sometimes it's worth to look into the smaller markets, like Portugal. And I found a company which I'm currently starting to buy. I already sold some stocks to add to this position. I'm talking about Sonae. Sonae is a bit of a special group, because if I tell you what they do, we would be sitting here for a few hours. They're basically a giant holding company operating in many fields. Now, what is interesting about this stock? 4 PE, 6 dividend, long history of revenue growth, and strong earnings per share growth over time. So let's go into it. Why am I adding to this position? Why am I planning to make it a huge part of my portfolio? Sonae operates in different business fields. Food and retail. Here they own Continente, which is a giant supermarket chain in Portugal, and Meio Super, which is a franchise store. We also have some other stuff here, some small areas, some health, beauty, wellness, stuff like that. But it's mostly that giant supermarket here. Then we have Wharton, which is an electronics store, but we're currently going more into everything. Then we have Sierra. Sierra owns dozens of real estate locations, from mixed use to retail, to residential, to office. They have a footprint all over the world. Of course, it's mostly in Portugal, but they also have stuff in, for example, Morocco, Germany, Spain, Italy, Romania. They have Musti, which focuses a lot on pet products. I can't really go into all the different businesses here, they're not really well shown. Basically, here they acquire a lot of pet brands, they have veterinary clinics, so they have a huge footprint all over that in Europe. Bright Pixel, an investment management company. There's so much stuff in here that it's not even worth looking at. But basically, they invest in smaller companies, mostly software. They own 37.4% of NOS, which is one of the biggest telecommunication companies in Portugal, which also owns the majority of the cinemas in Portugal. Spark Food. Here they buy a few alternative food companies, mainly focusing on vegan products, more sustainable food. I don't really like this segment of the business that much, but, you know, it's there. Bunch of fashion brands, financial services. So you can see this company is basically all over the place. It has real estate, retail, fashion, finance, telecommunications, food, investment management. This company has a lot of segments. And when you look alone at their net asset value, of their real estate, of their retail, of their telecom investments, the net asset value is 4.6 billion. The stock is currently trading at 1.75 billion. Now, of course, there will always be a discount for a holding company, but I would say this is a fairly harsh discount. Overall, over the last 12 months, revenue is up 9%, a fair amount of growth for stock trading at a 4 PE, EBITDA margin also slightly increasing. Of course, they don't have the greatest EBITDA margins, because they're mostly in retail, because they're in real estate. This is not the high margin businesses. You can't just look at the revenue, because a lot of their stuff is not fully owned. Some stuff which is like 75% owned, like the MC part, is gonna be accounted in the revenue. But for example, NOS, which is a huge part of the business because it is such a big company in Portugal, they only own 37%, so it's not really classified as revenue. It's classified as earnings from equity investment. Basically, let's say the company makes 1 billion in net income, you own 30% of a company, you count 30% of the net income to your company. And here, the earnings from equity investment has exploded in the last few years as they have made more and more investments. So the net income is growing even faster than the revenue because of that. Now, some segments obviously perform better than the other ones. For example, real estate has not really performed that much over the last year. Now, of course, because of the higher interest rates, while retail has, for example, grown by 9% for revenue, so it really just differentiates. Now, what do companies like these do? They acquire a lot of stuff. And just for the period, they have done a bunch of acquisitions. They mostly do smaller acquisitions. They usually don't have giant multi-million acquisitions. Remember, Musti is their pet brand. So here they bought a bunch of, for example, pet supply stores. They bought veterinary clinics. But they also bought, for example, Monderella, which is a vegan cheese brand from Germany. So they do a lot of acquisitions. When we look at their cash acquisitions, they do around 100 million per year at least. They had a few big acquisitions over the last 12 months. They put a lot of their cash flow into the acquisitions. If we see, they usually make around 200 to 300 over the last few years. Basically half of that went into acquisition. What did they usually do with the other half? They paid the rest out in dividends. So basically half gets reinvested into the business, half gets paid out to you as a shareholder. Sometimes they also sell off businesses, but over time they're a huge net buyer of businesses around Europe and the world, and that leads to this amazing revenue performance. It's not a fast growing stock like Mercado Libre or Meta, but overall this is a fairly conservative business which grows revenue fairly consistent over time. Plus they're very diversified in a lot of business segments, so this is a very safe business. A lot of investment companies take on a huge amount of debt to finance those acquisitions. They have a lot of leases, so for example their supermarkets, this is going to be classified into this debt, but that debt is not as bad as normal debt. And when we look at the normal long-term debt, it has not really moved up that much. Now, of course, because of a huge acquisition they had lately, it went up. But they also have a huge cash position of 500 million euros. And even right now, if you take in the 2 billion of debt they have, they make 400 million in free cash flow. So this company is fairly conservatively managed. They pay out a nice dividend over time while acquiring some businesses while not going too much into debt. And that leads to the amazing earnings per share growth. Now, why is it for that interested? There are a lot of businesses that over time grow by investing their earnings. While the stock has not moved at all, the business has grown fantastically. Now, of course, there will always be ups and downs in the earnings per share, but over time we can see the trend. It grows by around 9 to 10% per year on average. Company for that has to invest half of its cash flows into it to achieve that growth rate. But at the current 5 PE, even if a forward PE is a bit higher because of fluctuations, but over time I think this is the normal, it is a fantastic valuation for that. If I get 10% earnings per share growth, even if we go on 8% while getting a 6.2% dividend, that is a 14% return right now. So that stock is very interesting. Now, one thing I don't like is, currently they could put a lot of money into buybacks. Even if you continue paying off a dividend, so 400 million minus 160 million, 250 million, they could buy back a huge amount of their shares right now and basically grow earnings per share risk-free, way faster than they could with acquisitions. So while I like the acquisitions, on average, they buy a lot of stuff fairly diversified. Of course, I don't agree with everyone. I would just like for them to do share buybacks, but that's probably not gonna happen. Now, what am I willing to pay for Sonae? Now, I want to be conservative. Stuff can always go wrong in investment, especially if you rely on acquisitions to grow. What if management does a bunch of shit decisions? Underlying assets are great and still fastly growing. I'm gonna go with 18 cents in earnings per share. They're currently making 19. I'm gonna take a growth rate of 6% for the next 10 years. They're currently growing between 8 to 10% on average yearly in earnings per share. So this is a huge discount. 8 PE. Why an 8 PE? Well, I think it deserves much higher, but it is a Portuguese stock. As long as they're not listed outside of Portugal and attract investor attention, they're not gonna get a high valuation. The Portuguese stock market is very small, not a lot of people are looking into it, but this is a chance. This is a chance for small investors like us to invest into it. 40% payout ratio with a little deduction due to taxes, that's around what they historically paid out. With that, we would come to 1.47 euros. Sorry, I wanted to say dollars. It's all in euros, by the way, just so you know. Euros and share. Currently trading at slightly below 92 cents, but because all of these small cap stocks have a very high spread usually on stock exchanges. So just as a margin of safety, I'm including a very high spread in here. Even then, we get a 60% discount. For a stock that, in my opinion, is a very low risk. Not a lot of debt, great track record of growth, huge amount of cash flows, growing dividend over time. What if it goes to the historic 8% of earnings per share growth? And it gets a 12 multiple, which would still be too low in my opinion for the stock. €2.25 per share. So this is a fantastic stock in my opinion. Even if it goes worse, let's say the management does the worst acquisitions in history, all the cash they put in basically gets burned, and only the underlying businesses grow around with inflation and the Portuguese economy. 3%, 6 multiple, basically where it is today with a little bit of an upside. Even then, we make 10%. I'm buying the stock. I'm planning to make it a huge part of my portfolio until it comes to a level where I don't think it's fairly valued. So I'm definitely buying. What do you think? Write down below. Have a good day.